Right now, the Federal Reserve is 10 days away from the most important interest rate decision in years, and nobody is connecting the dots between the Iran oil crisis and what is about to happen to your gold and silver. What I am about to show you is the trap that is being set right in front of us. And by the end of this video, you will understand exactly why the next 2 weeks could define precious metals prices for the rest of 2026. Welcome back. If you are new here, this is the channel where I cut through the noise and show you what is actually happening in markets, while mainstream financial media is busy debating things that do not matter. If you watched the video about the Iran oil crisis and what it means for gold and silver, consider this the sequel, because that video showed you the problem. This video is going to show you the consequence, and the consequence is far bigger than most people realize. Subscribe right now and hit that notification bell, because the data I am about to walk you through is not being discussed on any mainstream financial channel. Not one. Let me set the stage. Gold is trading right around $5,185 per ounce. As I am recording this, silver is sitting at roughly $85 per ounce. The gold to silver ratio is approximately 60.8 to 1. Now remember those numbers because they are going to become very important later. Here is the situation. On February 28th, the United States and Israel launched coordinated strikes on Iranian military targets. The supreme leader was killed. Iran responded with missiles across the region. The Strait of Hormuz, through which roughly 20% of the world's oil supply flows, is effectively shut down. Oil prices surged to their highest level in over 8 months. And here is what almost nobody is talking about. The Federal Reserve meets on March 18th. That is 10 days from today. And they are walking into the single most impossible decision they have faced since 2022. Let me explain why this matters so much for your gold and silver. The Fed has 2 choices. Option 1, they cut interest rates to support an economy that is showing signs of strain. Unemployment has been creeping up. Consumer spending stalled in the December retail sales data. The labor market is softening. Under normal circumstances, the Fed would be cutting rates right now. But here is the problem. Oil prices are surging because of the Iran war. And when oil prices surge, inflation follows. It is embedded in literally everything. Your food, your transportation, your heating, your manufacturing costs. If the Fed cuts rates while oil-driven inflation is accelerating, they pour gasoline on an inflation fire, the dollar weakens, and gold explodes higher. Option 2, they hold rates steady or even signal that cuts are off the table for the rest of 2026. This protects against inflation, but it chokes an already weakening economy. Mortgage rates stay elevated. Consumer spending contracts further. And you know what happens during economic uncertainty and financial stress? Investors flood into safe haven assets. Gold explodes higher. Do you see the trap? It does not matter which door the Fed walks through on March 18th. Both doors lead to higher gold prices. This is not speculation. This is mathematics. And here is the part that should genuinely concern you if you do not own precious metals. The World Gold Council reported on March 5th that gold exchange traded funds absorbed $5.3 billion in February alone. That is 26 tons of physical gold flowing into investment vehicles in a single month. And that was before the Iran war escalated to where it is now. North American and Asian funds led those inflows. The smart money was already positioning before the bombs started falling. Now let me take you deeper, because the Iran crisis did something to the precious metals market that I have not seen before. It created a simultaneous triple catalyst for gold and silver. Catalyst number 1 is the safe haven demand. This is obvious. War breaks out, investors buy gold. It has happened in every major conflict. During the Gulf War in 1990 to 91, gold rose 7.5% in 6 months. After 9/11, gold gained nearly 6% in 1 month. When Russia invaded Ukraine in 22, gold rallied over 8% in the first month. The Iran escalation already pushed gold from roughly 5,100 to over 5,400 in a matter of hours. Goldman Sachs estimates an $18 per barrel risk premium is already baked into crude oil prices just from the Strait of Hormuz disruption alone. JP Morgan is targeting $6,300 gold by end of year. Deutsche Bank reiterated their $6,000 target. These are not fringe analysts. These are the biggest banks on the planet. Catalyst number 2 is the inflation resurrection. This is the one that nobody is connecting to silver specifically. Let me walk you through the chain reaction. The Strait of Hormuz carries roughly 20 million barrels of oil per day. It is disrupted. Oil prices spike. Higher oil prices feed directly into producer prices. US producer prices already increased 0.5% month over month in January before this war even started. Services prices jumped 0.8%, the most since July. Now layer a war-driven oil shock on top of that. The Fed was already struggling with core PCE inflation sitting at 2.8%, well above their 2% target. Fed Chair Powell admitted in January that if you strip out the tariff impact, inflation would be hovering just above 2%. But you cannot strip out the tariff impact, and you certainly cannot strip out a war in the Middle East that is shutting down 20% of global oil supply. Here is why this matters specifically for silver. Silver is both a monetary metal and an industrial metal. Roughly 50% of silver demand comes from industrial applications, solar panels, electronics, electric vehicles, artificial intelligence data centers, and yes, military applications. Every Tomahawk cruise missile reportedly contains 13 kilograms of silver. In a war environment, you get a bizarre and extremely bullish convergence. Military consumption of silver accelerates, safe haven investment demand surges, and the industrial base that needs silver for the energy transition and the AI build-out does not stop buying just because there is a war. If anything, governments accelerate domestic production of solar and electronics because they realize supply chain vulnerability during conflict. Catalyst number 3, and this is the one I really need you to pay attention to, is the COMEX delivery crisis that is unfolding right now in the middle of all of this. Let me give you the numbers because they are staggering. As of March 5th, COMEX registered silver, that is the silver that is actually available for delivery against futures contracts, sat at approximately 86 million ounces. Let me say that again. 86 million ounces. That is down from over 120 million ounces just last year. An over 30% decline. And here is what makes March extraordinary. According to CME data, 10,526 contracts are standing for March delivery. Each contract represents 5,000 ounces. That means 52.6 million ounces of silver are being demanded for physical delivery this month, against 86 million ounces of registered inventory. That is over 61% of the entire registered inventory being claimed in a single delivery month. Think about what I just said. In February alone, 5,036 contracts were delivered. That was 25.18 million ounces, the highest February delivery volume in modern COMEX history. And now March is demanding more than double that. The COMEX Stress Index, which combines coverage ratio, inventory trend, paper leverage, and vault outflows into a single score from 0 to 100, is sitting at 81. The all-time high is 88. We are 3 points away from the most stressed the COMEX silver market has ever been. And this is happening while a war is disrupting global supply chains and grounding flights out of Dubai, which is one of the world's most important physical bullion hubs. If you hold physical silver, I need you to understand how significant this is. The paper to physical ratio on COMEX right now is 6.9 to 1. That means for every ounce of registered silver that can actually be delivered, there are nearly 7 ounces of paper claims. If even a small fraction of those paper holders decide they want real metal during a war, the system faces a delivery squeeze unlike anything we have seen in the modern era. Now let me connect all of this back to the Fed decision on March 18th, because here is where the 3 catalysts converge into something truly extraordinary. The Fed is trapped between inflation and recession. Gold benefits from both outcomes. Silver has a structural supply deficit that has persisted for 6 consecutive years. Annual mine production sits at roughly 818 million ounces, while annual demand exceeds 1 billion ounces. That deficit is not getting smaller, it is getting larger as solar installations accelerate and AI data center buildouts consume more silver. COMEX vaults are draining at the fastest pace in history. Shanghai Gold Exchange inventory fell 43% from 559 tons in November 2025 to 318 tons by February 2026. The metal is not just leaving Western vaults, it is leaving Eastern vaults too. It is being consumed. And now I want to talk about the gold to silver ratio, because this is where the real opportunity sits for silver holders specifically. Right now, the ratio is approximately 61 to 1. That means it takes 61 ounces of silver to buy 1 ounce of gold. Historically, this ratio has ranged from 40 to 1 all the way up to 100 to 1 during the January 29th rally this year, when silver hit its all-time nominal high of $121.67, the ratio compressed to near 57. When gold moves significantly higher, which every major bank is now forecasting, the ratio tends to compress. Silver outperforms gold on a percentage basis during precious metals bull markets. This is not opinion, this is what the data shows every single cycle. If you want to understand what that means in dollar terms, think about this. JP Morgan is targeting $6,300 gold by end of 2026. If the gold to silver ratio compresses to 50 to 1, which is well within the historical norm, that would put silver at $126 per ounce. If it compresses to 40 to 1, which happened during the 1980 bull market, silver would be at $157. FX Empire's analysis shows a technical cup and handle pattern that broke above $92, projecting a move back toward the $120 all-time high with a potential extension to $150. These are not random numbers pulled from thin air. This is ratio mathematics combined with institutional price targets. Now let me address the one bearish scenario I know some of you are thinking about. What if the war ends quickly? What if oil stabilizes? What if the Fed somehow threads the needle? Oxford Economics published a note suggesting the conflict will not last beyond 2 months and that investors should sell extreme moves in commodities. Here is my response to that. Even if the war ends tomorrow, the structural damage is done. The inflation data that flows through over the next 3 to 6 months is already baked in. Supply chains do not heal overnight. Oil production shutdowns take weeks to reverse. And most importantly, the fundamental drivers for gold and silver existed long before the first bomb fell on Iran. Central banks have been accumulating gold for years. The COMEX was already draining. The silver deficit was already structural. The Iran war did not create the bull case for precious metals. It accelerated it. It removed the last remaining argument for patience. Comment below and tell me your realistic silver price target for 2026. I want to see what this community is thinking. Are you in the $100 camp? The $150 camp? Higher? Drop your number below. Here is what I want you to take away from everything I have shown you today. The Federal Reserve is trapped. Every path forward leads to higher gold prices. Silver has a structural supply crisis that is now being intensified by wartime demand and COMEX delivery pressure. The gold to silver ratio suggests silver has substantially more upside than gold on a percentage basis from here. And the institutional money, the central banks, the sovereign wealth funds, the JP Morgans of the world, they are already positioned. The question is whether you are. If this is opening your eyes to what is really happening, hit that like button. It helps the algorithm show this to more people who need to understand the dynamics at play right now. There are 3 types of people watching this video right now. The first type is panicking. They see the war, they see the volatility, they see silver swinging from $96 down to $79 and back up to $85, and they are paralyzed. They do not know whether to buy, sell, or hide under the bed. The second type is confused. They hear about the Fed, they hear about COMEX, they hear about oil, and they cannot connect the pieces. They know something big is happening, but they do not understand the mechanism. The third type gets it. They see the Fed trap, they see the COMEX drain, they see the ratio compression setup, and they understand that what we are witnessing is not chaos. It is a transfer of wealth from those who do not understand these dynamics to those who do, from the impatient to the patient, from paper to physical. Which type are you? Tell me in the comments. This is not financial advice. This is educational analysis based on publicly available data. Every individual must assess their own circumstances, risk tolerance, and investment objectives. Every source I referenced today, the COMEX delivery data, the Goldman Sachs note, the World Gold Council report, the Fed schedule, all of it is linked in the description below. Go verify it for yourself. If this video helped you understand what the Iran oil crisis actually means for your gold and silver, share it with one person you care about who needs to see this before March 18th. That is 9 days away. The clock is ticking. Subscribe to this channel for daily gold and silver analysis that actually gives you the full picture. Hit that notification bell so you do not miss what comes next, because when the Fed announces their decision, I will be breaking it down immediately. And if you are still stacking at these prices, comment physical below. Let us see how many strong hands are in this community. I will see you in the next one.